Hello viewers, Namaste. Today we have Mr. Niranjan Avasthi, Head Products Marketing and Digital Edelweiss Mutual Fund with us. He has over 13 years of experience. He is a cost and management accountant, plus he is Master of Commerce and from Pune University. Niranjan has joined Edelweiss Mutual Fund, in the year 2017, about 7 years ago. He is responsible for the overall product and marketing strategy of the mutual fund house. Before joining Edelweiss Asset Management, he was head of product communication at ICICI Mutual Fund for about 6 years. Prior to that, he has worked with Reliance Mutual Fund and Sharekhan as well. So he has rich experience in this area. And the context of this interview is Edelweiss Mutual Fund is coming out with a business cycle new fund offer, NFO. So we would like to, get more information on that from Niranjan. Niranjan, welcome. How are you?
Thank you, sir. Thank you for having me. I'm very good. Hope you're doing very well.
Yeah, Niranjan. So, now the markets are booming. Fund houses are coming out with new fund offers, almost every week, or, I can say in the past, we have done 2 NFOs, and this is the third NFO and actively managed, and few more are coming. And most of the market is expecting to be bullish in the next 3-4 years, economy to do well. So under this context, your new fund offer is Business Cycle Fund, Edelweiss Business Cycle Fund, which I think you have launched on 9th of July. So can you tell us briefly in very simple English about the new fund?
Sure. First, let me talk about all these new funds that are coming in the market. And if you see, most funds that are coming in the market are either sector or thematic fund. Reasons are obvious that investors want flavor of the current sectoral rallies. Like manufacturing is doing well. Technology is going to do well. Defense sector is doing well. So a lot of investors want a specific sectoral exposure in their portfolio, and that is the reason new funds are coming and people are investing in them. However, if we want to get our investments right while investing in sectors or themes, you have to get 2 things right. One is get the entry timing right, and the second important thing is get the exit also right. Because if you're investing in a sector or a thematic scheme which is very narrow, and if you don't get your entry and exit right, and if you stay invested for long run, your returns will be in line with any other diversified fund or market. But it is always very difficult to gauge which sector will do well, when to invest, and also when to exit. So with this fund, which is Edelweiss Business Cycle Fund, we are trying to solve that issue for the customer. What we are saying is, instead of having different sectoral funds in your portfolio or thematic fund, or trying to catch the flavor of the season, you invest in this one fund, and this fund will capture or catch the flavor of the season for you. What it will do is it will invest more in sectors that are doing well today, and then next year there'll be some other sector, likewise it will keep rotating between the sectors. Like after COVID, pharma and healthcare did well. After that, technology did well. After that, manufacturing and capital goods sector did well. This fund will help investors to invest in these sectors, take more exposure into these sectors, and generate that additional return over the benchmark that they are willing to invest when they invest in individual sector funds. So that is the problem which we are solving with Edelweiss Business Cycle Fund.
Okay, very good. So you are saying instead of investing in 10 funds, invest with us with only one fund, and we will take care of the rest. That is a kind of one-stop solution kind of thing.
Yeah.
So why you are launching that fund, that Business Cycle Fund, right now? Is it, what is the context?
Right. So there is one very important reason, because broader markets are doing well at this point in time. But as economy is growing, also our economy is shifting towards maybe manufacturing, and other industries also away from services.
Mhm.
Government is focusing on few sectors, be it defense and manufacturing as a theme. PLI schemes is being run for manufacturing. At the same time, services sector is very big for India. That will also do well. Banking sector is backbone. Banking sector can also do well.
Yeah.
The thing is, every for every sector, the cycle could differ. Initially one sector would do well, then later on some other sector would do well. And we believe in this overall bull market rally, which we may see over the next decade or so. There will be very good and big opportunities within these sectors also.
Okay.
And we wanted to capture or give a meaningful exposure to these sectors and rotate between these sectors over a longer period of time for the investors, which can add, additional return. And specifically, you see when we are in a good bull market, there are various sectors that can generate huge amount of returns.
Mhm.
And, it can increase the overall, diversification of your portfolio also, and give you that additional alpha. And that is the reason we thought through this fund, we will be able to capture those sectoral flavors, which a normal diversified fund won't be able to do, because their sector weights are usually in line with the benchmark plus minus 5%. But here, it will be a sector agnostic fund. We can take, the fund has ability to take more exposure into sectors that are doing well and give that experience to the investor.
Okay, okay. Very good. So, I mean, you are expecting the economy to do well in the next 10 years, 5 or 10 years. And during that phase, there could be a lot of sectors which can do very well than
very
other
well.
sectors. Okay.
Yes.
And I mean, do you expect, I mean, this is a normal question but investors wants to know, do you think that investors can make good money from your current offering, which is the business cycle fund?
So the way we have designed this product is a normal diversified fund, whether it is flexi cap or a large and mid cap fund, are designed to generate maybe 1 to 3% additional return over a benchmark by taking, plus minus 5-10% sectoral calls, by stock selection, and maybe by, investing across market cap. In this category, what we are going to do is the sectoral exposure, as I mentioned, can vary from 0% to 40%,
Okay.
irrespective what it is there in the benchmark. In simple language, financial services in Nifty 500 benchmark is roughly 30%.
Okay.
A normal flexi cap fund will be, even if the fund manager is very negative, may take maybe 20-25% exposure. If he is very bullish, he may go to 35 or maybe 40. But
Yes.
in this fund, if the fund manager is, or if the fund is bearish on that sector, it doesn't think that financial services is great enough to make money for next 1 year or so, the exposure can be as low as 0. And if they think maybe healthcare and pharma is doing well, and there the exposure needs to be higher, irrespective of that being just 6-7% of the benchmark, here the exposure can go up to 40% also. So this variation in sectoral allocation by design adds an additional, the aim is to generate additional 5 to 6% return over normal diversified fund or flexi cap fund or a larger mid cap fund. So that is the aim of the product. Now, whether we will be able to deliver it, of course, time will tell. But because it's a strategy that we have back tested and looked at all the numbers, on an average, on a 5-year rolling return basis for last 12 years, the strategy has been able to outperform by 5% over the benchmark, which
Now,
is a
the same,
meaningful additional.
sorry, Niranjan, the same strategy, where else, in which funds that you have used?
Right. So on the strategy, briefly, it is basically a strategy which is rule based. We look at, various qualities of stock like growth, quality, momentum, and valuation, and then select stocks. And it is a framework. Some people say it quant model. Some people say it is a model driven product. So
But
yes, it is a
I
process.
think you have specifically used in your balanced advantage
Yes,
fund,
yes,
in
I'm
your
coming to
large
that.
cap
So,
fund,
yes.
and one more fund, if I remember correctly.
Yes, yes.
So,
So this strategy we have been using in a large cap fund for last 15 years. It
okay.
is the oldest fund probably in the industry, one of the oldest fund which runs based on a quant model, and it has generated good returns for our investors. We also run this product in one of our largest fund in the hybrid space, which is Balanced Advantage, Edelweiss Balanced Advantage Fund, which is almost 11,700 crores in AUM for last 15 years. We also run this in our aggressive hybrid fund.
Hybrid fund, yeah.
It's a large fund and we use the same model. So we use a combination of these factors and models to solve different problems in our different fund. And in business cycle, we are using a version of that model to solve sector rotation issue for our investors.
Okay. And as you told, we will be able to generate little higher return. We should be able to, otherwise people can go with a normal diversified equity fund, which is large and mid cap, multi cap, large cap, all those things, or small and mid cap, all those things. So you should be able to generate higher returns for the additional risk that is taken by the investors. This being a thematic fund, this carries little higher risk than diversified equity fund. So will you be able to satisfy that investors' expectation of additional, maybe say like 1 or 2 or 3%?
Right. So it is a good question that, when I say we are aiming to generate maybe 4 to 5% additional return over benchmark or normal diversified funds, what is the risk? So risk, one of the metrics that we look at is standard deviation or volatility. If you see the volatility of this strategy, the backtesting that we have done, it is actually in line with normal flexi cap or a large and mid cap fund, or in fact, in line with the index, which is benchmark. So essentially, we are not taking any additional risk. What we are, how we are generating that additional return is ensuring that the stocks or the sectors that we are investing have good earnings growth and momentum and quality and valuation. So by ensuring that all these factors are there in a stock, in a sector that we are buying, that additional return is being generated. So generally we think, if the returns are higher, risk will also be higher. But in some cases, when you craft a strategy where you want to keep returns at a little bit higher level, but risk at similar level, that is possible. And that is what we are trying to do in this category. Similar risk profile like your diversified fund, but with a slight bit of additional return. That additional return is coming because we are able to take sector calls and also rotate between the sector. So that is where the additional return is coming from.
Okay, very good. And then another question, which from an investor's angle is, already there are 4, 5 or 6 business cycle funds. Yeah. Why I should come to Edelweiss in this NFO? Right.
So, traditionally the approach in business cycle funds is, if you were to take a call on which sector will do well, it will be based on your judgment, based on the macro indicators that you are seeing. And it's a judgmental view that which sector will do well. Here our approach is not judgmental. Here our approach is which sectors are doing well. So instead of investing in which sectors will do well, we are investing in sectors that are doing well, because it is all data driven. So that is fundamental difference, which actually helps us, go right more or many times higher than a traditional approach. So our probability to go right with our sector call is much higher versus any other business cycle where it is a judgmental call. Here it is data driven, it is fact driven. We see the prices are moving. So we call it a pro-cyclical approach, because you know which sectors are doing well, you identify them, invest in them, rather than taking a call which sector will do well and wait for those sectors to do well.
Okay, sure. And then the one more thing is my perception, I may be wrong or right. Whenever NFO comes, I ask this question. Many fund houses want to time their NFO so that, they generate a better return since inception return.
Right.
So in that way, how you are positioned? Is it one of the reasons that you are finding that it's very attractive right now for a business cycle fund and you can make a good money?
Yeah. So, historically at Edelweiss Mutual Fund, we have launched very few NFOs. In fact, last, if you ask me, pure equity fund, including thematic and all, in the last 6 years, we have launched only 5 funds. In last
Right.
6 years.
Okay.
We launched Edelweiss Small Cap Fund back in 2019 when no one was looking at small cap, no one was talking about small cap, and it has generated multiple times return for our investors.
True.
After that, we launched, focused fund. It has generated returns. We launched multi-cap fund 7-8 months back when slightly there was a correction in market, and it made good returns for our investors. One thematic fund after many years we launched was technology fund just few months back because we believe that technology would do well and the valuations are attractive. Now we are launching this business cycle fund on 2 counts. One, we believe that market is very good and returns can be made over the next couple of years. It's a good time to invest. Second, a lot of people are taking additional risk by just investing in one sector, one theme, narrower sectors and theme. This strategy would be better for them with much lower risk and plus additionally getting the flavor of those sectors that are doing well.
Okay.
So from that perspective, we thought this could be a right time and investors can be better off investing in this strategy versus narrower sectors and themes.
Okay, just to understand, you are saying that instead of investors putting money in a pharma fund, in a banking financial services fund, or technology fund, FMCG fund, you are saying that give the money to us, we will play the sectoral cost.
Exactly.
Okay.
That will be our job.
Okay. Instead of choosing, the investor need not choose which sector to do, which is underweight, which is overweight, and all those things. So
Yes,
they just
we will
give
do
you the
that.
money and you decide on behalf of them. Very good.
Yes.
That's very logical. And it's like the one more thing is nowadays the industry expectation has gone up too high. When we say 12%, they are saying only 12%. Can I make 24? Can I make 36? That is the kind of discussion we are having with customers. It's very difficult because the markets in a quite rightful way has gone up so much in the past year particularly. So now if an investor comes to your fund, how much he can expect going forward? Say like if he remains for a 5-year time horizon or 7-year time horizon, remains invested, he is not going to redeem the fund on a CAGR basis, how much he can expect?
It's a very difficult question, sir. I don't have those numbers and you also know it. But yes, investors' expectations are very high. And but the way we have designed this strategy is, as I mentioned earlier, to generate additional return over whatever market returns are. Now, let's do a simple calculation. What returns can we expect from the market over the next maybe 5 years or more? Generally, if you see market returns are always in line with the earnings growth. And your earnings growth are usually in line with what is your country's nominal GDP growth. Now, we are expected to grow at the rate of maybe 12 to 13% on nominal GDP. Our real GDP growth, we are expecting somewhere around 7%. Add inflation to that, nominal GDP growth can be somewhere between 11, 12, 13% in that range. Now, equity markets, can deliver somewhere closer to this, maybe 13, 15%, 11%. So that is the range, 11 to 15%. If that is the range, this strategy can over and above that because of sectoral rotation, because of taking those right call in which sectors are doing well and allocating more, it can generate maybe 4 to 5% additional return. So if market return range could be 10 to 15, this fund's return range could be maybe 15 to 20 is the aim using a strategy and model. Now, these are not absolute returns. These are not, guaranteed returns, but this is broad what the expectation can be. If market returns are 5%, this range can go down to maybe 5 to 10%.
Yeah, definitely.
It is all linked to market, but I think so we are in a good market. India is growing. Government reforms are in place. Consumption is booming. People are becoming richer. Large population is getting added to middle class population in India. India is still one of the youngest country and also fastest growing country. So I don't think so expecting anything below 12, 13, 14% returns from Indian equity over the long term is unwarranted. So I think so it can make returns for investors.
Good returns, decent returns over a period of time. And the time horizon, what is the minimum time horizon? Maximum, of course, forever. What is the minimum time horizon people should consider this fund?
So, like other equity funds, I think so 5 years is a decent time period. Someone should give this strategy to work out.
Workout. Okay, okay, very good. And of course, the markets are overheated. That is general feeling. In between, SEBI also came. They told that small cap, mid cap is overheated. All those things went on. Discussion went on, but still markets are going up. So, are you comfortable under these market conditions to launch this product?
So definitely small caps are not cheap. They are slightly expensive. Overall markets, I think so, given the earnings growth and given economic growth, is reasonably priced, especially some very good mid caps and large cap stocks are reasonably priced. There are some pockets where there is exuberance in terms of valuation, like, second rung, maybe defense stocks or maybe PSU stock, just because their names are PSU, they are trading at, very high valuation. So one needs to stay away from these. And hence I said, people are taking a lot more risk by investing in narrower sectors and themes, because there the valuations have gone up. In a diversified fund, actually the risks are, very well measured versus the rewards that they can earn. So I don't think so. Overall market is very, very heated. It is not cheap, but somewhere, reasonably priced. If you are having a diversified portfolio across sectors.
So still it is good time to park money, to invest money for the next 5 years.
Absolutely.
Okay, okay. And getting into the details, what is the minimum amount a person can invest in this NFO?
So minimum amount starts from 100 rupees. So mutual fund is for everyone,
Okay.
anyone. Maximum, there is no limit. So I think so.
So minimum
anyone can
100 through SIP route.
SIP, even lump sum is 100 rupees.
Oh, even lump sum is 100, not 5,000.
No, it is 100.
Oh, very good. In that case, that is great. That is great. And one more thing, I think there is SEBI mandate everything that you should be putting your money. So is it applicable to you as well? And are you putting money in this NFO?
Yeah, so I mean, as an employee, as a guardian of product function and many other function at Edelweiss NF, our salaries are definitely invested into these funds by default. Additionally, also we do invest in our own fund. So yes, we will be investing in this fund.
In this fund as well. Very good, very good. That is on a very positive note that will give confidence to the investors who are going to invest. And thank you very much for giving time. And I wish good luck in this NFO.
Yeah.
Thank you so much, Niranjana.
Thank you so much for having me, sir. And hope you and your investors invest in this fund and reap the benefits of this.